This is the one that I sort of mentioned last time about the bankruptcy filing and the fact that it's become more difficult to file under Chapter 7, which is the more stringent of the bankruptcy filings. 7 is complete liquidation, as it's called, whereas Chapter 13 is known as reorganization. So Chapter 13 is, as I said, is the less aggressive form of bankruptcy. It's not really a bankruptcy, but a sort of a structured reorganization of your personal finances. Chapter 7 is liquidation. And it's gotten harder to file, as I said, under Chapter 7 since this law was passed, because you have to be really poor, as defined by the state you live in, to be eligible to file for Chapter 7, and eligibility is defined by the median income of the state of your residence, and if you fall underneath that median value, if your income is underneath the median value, then you qualify, otherwise you don't. So that makes it tougher. So this is widely regarded as a pro-industry, it's an industry-friendly law, because this was really heavily pushed by the industry, the credit industry, because there was a feeling that individuals and families game the system, and a lot of people just want to get out of irresponsible behavior by filing for bankruptcy under Chapter 7. So, as I said, child support, alimony, student loans, and taxes will not be wiped out under any circumstances. So regardless of what you do, bankruptcy is not going to take care of those issues. You still have to pay those payments, make those payments. So, okay. So the other rules that have gone into operation that have made credit relatively protected and you know, for your protection, basically, is that these rules on interest rates, what banks could do and cannot do now, is that before the law, banks could raise interest rates on any account at any time, including a rate on existing balances. This is unusual because notice when you talked about bonds, the coupon rate, once a bond is floated in the market and sold, you cannot change the interest rate. The interest rate is fixed for the life of the bond. So with standard instruments, lending instruments, like for instance when you get a mortgage loan, well, with fixed rate loans, of course, the rates won't change. But even with variable interest rate loans, variable rates, the interest rate fluctuation is predictable. They have a set formula on which they're going to raise interest rates if necessary, depending on what happens in the economy. But here, credit card companies can just willy-nilly change within a week. They can, you know, change your rate, interest rate. They could. Initially, they could do that before the new law was passed. And now, after the law, of course, that's become very difficult. Banks cannot change interest rates on you just that abruptly. There are now guidelines that they have to follow, and they have to give you an opt-out option that if you don't want to, you can pay off the loan and get out of the card. So let's say they raise interest rate, they have to give you a 45-day advance notice that they're going to do so, and then you have the right to say, I don't want this, and pay off your existing balance and get out of it, of the agreement altogether, which you weren't allowed to do before. So it gives you more flexibility and more protection. Fee restrictions, again, as you can see here, I'll let you read, but there are restrictions on how much they can charge you and so on, so they can't simply go crazy over charging fees. Disclosures. This is an important disclosure agreement, which again was not a popular thing by credit card companies. They didn't want to put this in. But this is now cardholders, if you look at your statements now, and I'm sure you have, and you'll notice that it'll have how many months it'll take to pay off the balance if at minimum payment. So if you make the minimum payment, how long will it take you to pay off your existing balance. That's meant as a wake-up call. That's meant as a jolt to you to say, hey, do more than this, because it's really going to be costly for you to make the minimum payments. And also now the minimum payments themselves have been doubled. So it used to be the case before that your minimum payment per cycle was 2% of your outstanding balance. Now it's 4%. So it's been doubled. So your minimum required payment has gone up, doubled, which is good in the sense that it allows you to pay off your balances sooner rather than later. There was this notion of universal default. In other words, if you universal default is a funny thing in the sense that if so a lot of these cards would come with a universal default proviso built to it, and what that meant was the company that issued that card could increase rates on that card even if you were up to date on all your payments with regard to that card, that you were perfectly behaving with regard to that card, it didn't matter. If for some reason the credit card issuer thought that your risk has gone up, let's say you've been late on some other payment unrelated to the card, they could use that to increase your rates. And that was universal default. And so that was a very onerous thing that a lot of cards had. Now, again, rates have to be if a company wants to raise interest rates on you under the guise of increased risk, then they have to give you advance notice, and they also have to give you a chance to opt out. If you don't like that increase and you'd rather go elsewhere, you can pay off your debt and at the current rate and get out of the card altogether. So a lot of good things have come about. For students, especially such as yourselves, this is now before, and I've talked about this every semester. When in the early days before this law went into effect, the campus before classes started in fall was like like going to a carnival. There were all these credit card companies were on campus, and they had set up all these tents and as you walked to and fro in between and wherever, and they were all set up, and they had recruited students to work for them, and the idea was you signed up for these credit cards, and then you'd get a coffee mug or a t-shirt, or there was a whole big festival around before classes started in August with credit card companies all over campus. And so now you don't see that. In August you walk around, there's nobody, because that's illegal now. They can't do that. So that sort of changed for the better. And now, of course, credit cards cannot be issued to anyone under 21 unless you have a cosigner or can show independent means. So if you have a job that you make enough money, you can get a card on your own, and that to the limits that you get are drastically reduced, credit limits and stuff like that. So in a way, things have gotten tighter. And companies are now forced to be more discerning in who they give credit to because of all these increased regulation, which sometimes can be bad news for some students, because you probably in the previous pre-bill stage, pre-law stage, you could have gotten a card. Now you may not qualify because the standards of qualification have gone up. But my feeling is that's for the better. And so, although not all of you may agree, but so as you can see, banks are not allowed to hand out gifts on or near college campuses. So nothing of that sort is allowed. End of double cycle billing, which is a way to make more money, interest payments for banks. Gift card protection, no expiration. So gift cards used to expire within a year, and as you know, there's a lot of people just put them in the drawer and forget about it, and then before you realize it, it's expired and you've lost money. Now they have to have at least 5-year lifetime, so on. So a lot of things have been tightened up in the wake of. Well, I'm going to let you read these at your own time. Identity thieves. There's not a whole lot to say about debit cards, and I've sort of scaled down, over the years. But debit cards are, as I said, it's like glorified check writing, right? It's a plastic version of writing checks. And that's all really you need to keep in mind. So it's not going to affect your credit scores because debit is debit, credit is credit. They're separate things altogether. So, but with debit cards, you get essentially the same protection as you would with a credit card. So if some scam has happened in your account, you are not responsible for what's happened, you know. So I'm going to just let this go. Again, like I said, I mean, there's just a similar kind of, the debit and credit gets pretty much similar protection under the law in terms of whether when there's some kind of fraud perpetrated on your account, it's the same for both. There's really nothing more to say on that. If you have any questions, put them on hot seat and I'll look at them. I'll let you look through these. There's just these different cards. The point of this is the following. There are credit cards and credit cards, and not every card is suited for everybody. We don't really think about it that way. At your age, maybe you just want a card with a decent balance on it. But when you think about it, and maybe as you get older, you understand that depending on how you're going to be using the card, you actually can choose different types of credit cards. Not all credit cards are created equal. So, for example, first question you have to ask yourself is whether you're likely to revolve credit or whether you're likely to pay off your balances at the end of the cycle. If you happen to be one of those people that's going to use credit card and then pay off your credit card and then pay off the balance entirely at the end of the cycle, at the end of the billing cycle, in other words, you're not going to revolve, then you have a whole set of criteria as to what is appealing to you. So for somebody of that nature, so who's going to not be a revolver, you care about interest rates. Don't matter to you, right? Because you're not interest rate sensitive, because you're not going to use interest rate. You're not going to carry over loans for the interest rates to even trigger in or get into, come into the mix. And therefore, you don't care about interest rate. You're interest rate insensitive. You're not sensitive to interest rate. So then you care about perks. You care about things like mileage, maybe if you travel. You care about frequent flyer miles, as I said, or maybe cash back bonuses. So you should choose cards that offer those kind of perks to hold. On the other hand, if you know that you're going to be a frequent revolver of credit, then you are interest rate sensitive. Then interest rates matter to you. Then you should pick a card that has the lowest interest rates. In case you carry over your balance, then you need to have a card which will have a reasonable rate of interest. Now, granted, you may not qualify for all of those cards because the cards that have the lowest interest rates are also the most stringent and more difficult to qualify for obvious reasons. So you are going to, but do your best to get the best lowest rate card that you can get with your credit record and background and all that. So that's sort of the moral of the story here, that you need to be more strategic in choosing credit cards. That's all that I'm trying to say here. Okay, so credit card is not just about getting the first card you can lay your hands on. Maybe for some of you that may be the case, but at some point you got to realize that you've got to be more strategic in your choice of what kind of credit cards to hold, depending on how you plan to use the card. That's the key element here. So wait for the right card. So the microfinance, I just want to talk about microfinance because for a brief moment, because, or rather relatively quickly, because microfinance really started in underdeveloped, relatively underdeveloped countries in the mid-70s. Where you had millions of people who were poor, banks wouldn't lend money to them, and so you had this growth of these, led by this gentleman who had a PhD from Vanderbilt, actually, economics PhD from Vanderbilt, Muhammad Yunus, who went back home to Bangladesh and then discovered this plight of millions of people who wanted to borrow little, small chump change, basically, but banks wouldn't give them money. And then he started this whole revolution, if you will, that's now global, with microlending, microloans. In fact, the bank that he founded, Grameen Bank, is now in the U.S. as well, in Brooklyn, and they have Grameen USA that lends money to small entrepreneurs in the Brooklyn area, New York State, and other parts of the country as well. So microfinance has come to the U.S. as well. And and it's all about lending money to entrepreneurs. So if you're a micro entrepreneur, you want to open a shop, you want to open a small business, this is a way to get money and under reasonable interest rates. So you don't have to go to a loan shark or get exploited in terms of interest rates. So this is now a huge movement. It's a global movement, and including has a fairly big footprint in the U.S. as well. These are, for the most part, when you look at it globally, the clients of microfinance are poor, considered to be poor by standard definition, which means that conventional banks do not give them money. Conventional banks don't give them money for the same reason that a bank might not extend a credit card to a lot of you who may not have a track record. Remember, we've talked about this, that it's the same story over there as well, that you don't have a track record of loans and therefore you don't qualify for loans or a credit card. These people are the same way, that they don't make a lot of money, they don't have assets or to pledge, to get collateralized loans, and therefore they're frozen out of the conventional loan market, and therefore these microfinance institutions have come to the rescue to give these budding entrepreneurs a way to get some money under reasonable interest rates and put that in their businesses, invest that in. So, and one of the ways, and this was the innovative thing in microlending, and this was an innovation that this founder, Muhammad Yunus, came up with, was, so the conventional knock on these people was they were so poor that they couldn't afford to put a down payment or to put something as a pledge, as an asset, like as a collateral. They had no collateralized assets that they could pledge to a bank, and therefore they were not getting any money. Well, what this guy decided was he made groups of loans. So he started this movement where these potential borrowers would come together as a group. So say a group of 5 entrepreneurs came together as a group, a borrowing group, and then they would get money as a group, and they were responsible for policing each other with the monthly payments or the weekly loan payments. And the idea was that if any one of them failed, any one of the 5 failed to make their weekly payments, it was up to the rest of the group members to come through for that person that week. And the idea was, as long as you made your weekly payments as a group, you could continue getting money. And this idea is called, this idea is this joint liability. This joint liability feature was a huge success, because it turned out that after, these micro programs have repayment rates of 95% and above, which is phenomenal, which is not even close to what banks see in their conventional loan market, not even close. So this whole movement, the great thing about this movement was that they defied all the odds. These were poor people who were not supposed to do well with the loan market because they had no assets to pledge, and yet these guys were performing way better in their loan repayment than conventional loans were generating for banks in terms of the repayment rates, which were, as I said, 95% or above. So that was phenomenal, and that was a lot of it is the credit is given to this phenomenon called joint liability, which is what I described to you just now, that the group members police each other, make sure that everybody's playing the game, because they all have a stake in this, right? So if some member of the group fails, it's up to the others to pick that person up that week and make that payment for him, because when it's your turn, somebody else will step in for you. And that way, collectively, the group succeeds. All right. I guess this movie is not playing well because there are people who are leaving the theater. But this is not a hit. All right. Anyway, so there's all this stuff here, details about how the microfinance works in this country. Here's some top U.S. MFIs, U.S.-based MFIs that work in Axion, Opportunity Fund, Justin Peterson Housing, Women's Initiative for Self-Employment, and so on and so forth. So you can see that this movement has come to the U.S. and it's fairly popular. So microfinance, what are the challenges faced by this industry? It is one of the challenges is that as the market's growing, as these microfinance institutions are growing, they're starting to look more and more like conventional banks. And that's a problem, because ultimately the initial goal of this movement was to provide outreach. In other words, to help the really poor reach a certain level of prosperity or whatever have you. And now, as the market has matured relatively, these microfinance institutions are making larger loans for relatively larger amounts, and they have gone away from this group movement to making individual loans, and even to people who have assets. So the movement has shifted from poor, no asset type people to relatively well-off people with assets and larger loan amounts and individual loans against group loans. So the movement has sort of moved and shifted, and a lot of people worry that now these institutions are starting to resemble conventional banks, which is not a good thing. All right, let's see what's happening here. What is microfinancing comprised? Why? I think that's a why. Why is microfinancing comprised of more women than men? Great question. That's a wonderful question. Who's asked this? Has he or she? Anonymous. Okay, Mr. or Ms. Anonymous. That's a great question. So you can identify yourself proudly. There's several. It's not a one-size-fits-all answer. There are certain parts of the world where women are considered, so they have historically been disempowered, if you will, and women have, when you talk to microfinance institutions, and I have several projects ongoing in certain parts of the world on microfinance, banks will tell you, or these microfinance institutions will tell you, that women are more responsible, and they make better customers because they are much more responsible with their money. So banks prefer to lend to women more than men. In certain parts, religion plays a role. So certain parts of the world, women are, this has allowed them to come out and be and given them and empowered them in more ways than one, that they can run these businesses on their own, and they're generating money for the family. But ultimately, the answer is that women are considered to be more responsible. They are more risk averse. They are more cautious with the money. They spend money responsibly, and that's why lenders prefer women clients. It's a very good question. Who or what institution lending to?
So where does the money come from?
I don't think that's a question. I mean, that could be a question, but who or what institutions are lending money? These microfinance institutions are, they can be depositor funded, but for a lot of these microfinance institutions are funded by subsidies that private clients can give, donations, subsidies that can come from governmental sources or private clients. And there are a lot of models also now of microfinance institutions taking money in from depositors, much like a conventional bank. So it varies all over the place in terms of the source of money. How often do laws about credit card change? Not too often. Not too often, because to change laws like that takes a lot of work. So talk about Obamacare, which, I hate to, use that term because that's a derisive term that the one party has come up with. It's really Affordable Care Law. The name of the law is Affordable Care Act. That was, do you know when the last major reform was, health reform was before this one? It was Medicare law in 1965. So it took about 35 years or more for another major law to be passed on the healthcare front. So yes, it doesn't happen too often for this very simple reason that it's very difficult to pass major laws under the current political system. There's so many, so you have the lobbying groups, you have counter interests of politicians, And so to make all of these things work in a way to pass a bill that requires support from both parties is a Herculean task, almost an impossible task now. And given how polarized either side is, it doesn't matter which side of the aisle you're on, it's a polarized country. So what is right for one is wrong for the other, and vice versa. So it becomes very difficult. No matter what the law is, whichever side it is, the other side is going to oppose it. And so it becomes very difficult to pass any law of major proportions. I mean, you can pass little incremental additions, which is what's happening for the most part, but to pass a major reform or a major change requires, it's almost an impossibility now under the current system. So that's all I'll say about it. Anything else? Again, one more before we get to insurance. Could I start a company that pays thousands of people in agreement to track their purchases, then the information to decipher the FICO, and sell them? I'm not sure I follow this.
The student wants to know if he can start a company to crack the FICO.
Well, the question is, will people believe you that you've cracked it? That's the whole problem. I mean, how do you credibly tell, unless you are, you're a great salesperson and you can convince people of something, in which case, I'm sure there's a bridge you can sell somebody with your name on it. So it's not a question, how would you, you came to me and said, hey, I've got a company where it's cracked the code. Well, okay, how do I know? What do I compare it to? How do I know that you cracked the code? You're just not selling me a bag of goods. So it's hard. I don't know. I mean, that's the best I can come up with. Would I have to go into my bank to renegotiate my APR? First of all, bank loans are not negotiable. Once you sign a contract, the bank loans themselves are not negotiable. I think if you're talking about credit card, that's a whole different discussion. You can call them on the phone to renegotiate a term. If you're having trouble and you have to submit documentation, they will ask for things. They're not just going to take your word for it, but you can renegotiate the terms of your payment of your credit card related loans. But the loans that you take out, I guess you could. I mean, even a mortgage loan, if you're having trouble making payments, you can, if it's a mortgage loan, then you go to your bank and then you submit paperwork and to show where you are and all that. But yes, it is possible, I suppose, because the same rule applies for conventional loans. But it's more common with credit card related loans where you negotiate the terms or renegotiate the terms to suit your budget.
That's about it.
That's about it. Okay. All right. So now we move to module 3. And we're going to talk about insurance. And insurance, this is, if you recall, tying it back to the theme that we started with at the beginning of the semester, was the offense-defense idea, right? So we're now in the defensive mode. This is a defensive module where we learn to play defense. There's pure insurance is all about defense, nothing else. It's playing good defense. And so this is our where we start looking at insurance and defense. And so why do people need insurance? To manage risk. We have risk, and so risk, definition of risk is the likelihood of an adverse outcome or adverse event. So risk is nothing but the likelihood of an adverse event. And the higher the risk, the higher the likelihood. So, and people, so in order, and people buy insurance to manage that risk. And we'll talk about how in a second. All right. So there are various ways to manage risk. So before we talk about insurance contracts and all that, so we have risk. The fact of the matter is that the moment we step out of the house every day, for business or for pleasure or for both, we are taking a risk, whether you like it or not, right? You can be hit by a bus or a car or on campus by a bicyclist who tumbles all over you, and then you're in the hospital after that. Or whatever. I mean, you can have so many things that can go wrong, and that's all at risk. You're taking risk. And insurance is a way for you to help you deal with that in an affordable way. Right? Because if you break something, you fall, or somebody tumbles over you, and you go crashing into the ground and you break a leg. Well, if you go to the hospital or the emergency room, I don't know if, I'm sure some of you have, and I don't know if you've seen the bill that comes through, it'll be a few $1,000s. And if you don't have insurance, then you're expected to pay that, most of that. So that becomes a problem for most of us, and therefore you have insurance to help you pay for some or most of that cost. So so how do you deal with risk? Risk, the easiest way is to avoid it, avoid risk. So avoid doing things that might put you in jeopardy. So here's an example. You don't drive because you want to avoid getting in a car accident. Yes, that might help you in some ways, but it doesn't take away all aspects of risk. But it's not, like I said, it's not possible. If you live, if you get out of the house in the morning, avoiding risk is not a practical solution. Prevention, control, risk prevention. So you do things that prevents or reduces the severity of the loss. So driving within the speed limit reduces the likelihood of an accident. Wearing a seatbelt can reduce the severity of the accident, given one happens. Is this the right place for me to bring out my 12 to 4 lecture that I've given you once before? I'll give it to you again. As I've said, nothing good can come to you when you're out of your bed between hours of midnight and 4 a.m., right? Nothing good can happen. I don't care what it is, but just good things don't happen at those hours. So you're better off in bed, in your own bed, hopefully. You want to, so one can say that, okay, that's a way to prevent risk or reducing the severity of the risk, that you just go to bed, in your own bed, between, at the proper time, and you get a good night's rest to come to class the next day. And so that is an example of prevention, and maybe of control as well. Okay, so then, of course, comes the kicker, assuming the risk. So if you don't, so a good example of this is you have no health insurance. What does that mean? You have no health insurance, that means you're assuming the risk yourself. So God forbid if something bad happens to you, then it's all on you. You have to pay for it or find the money to pay your bills, medical bills. So and then, of course, is this called risk transfer, that for a certain sum of money, you can transfer part of your risk, not all of your risk, but part of your risk, to a professional company, i.e. the insurance company that will come through, hopefully, when you need it. And for a sum of money, you get an insurance policy, and then hopefully, if something not hopefully, if something does happen due to a stroke of bad luck, then you get partially reimbursed for your treatments. And so the question is, why would an insurance company do that? Well, they're doing it, they're a profit-making entity. Insurance companies are not in it for social service. They're not a charitable organization. In fact, I don't know if you've looked at their profitability statements. Insurance companies are one of the most profitable companies in the country, rivaling oil companies and the like. So insurance companies are hugely profitable business. Insurance companies do this to make money, but at the same time, you need protection. They are there to provide protection for a sum of money, and it works out. Insurance companies do that. It's a business for them. So so when we talk about insurance, we're really talking about the risk transfer aspect of it. That's what we focus on. The rest of it you can deal with. You can do it on your own or not do it on your own, as in the case of risk assumption. But risk transfer is where we focus our attention on for the rest of this module. So I don't know how deep a thought this is, but certainly somewhat, maybe not a shallow thought. But what is the difference between insurance and speculation? So speculation and finance, we've talked about speculation in financial markets. What is the difference between insurance and speculation in financial markets? Quick pause. You You can use your hot seat if you have a thought, a deep thought. Shall you make a poll? Yes, why not? Let's do it. We haven't polled. What do you think? Have you heard that? Is that it?
No.
That's not it. What is speculation? Okay. All right. I'm sorry. I took that for granted. Speculation is when you speculate in the markets, speculate in the financial markets and stock market. Speculation means you invest. You take risk and you invest. You speculate. You're a speculator. You can be a venture capitalist. They're speculators. You can bet on horses. They're speculators. You can do whatever. I mean, so speculation is basically investments. If you really parse through it, basically, what's the difference between insurance and investments? All right. I don't know if that helps, but okay. So one response, I'm not quite sure. All right. Yes. So the difference is very simple, as people quietly file out at the back. What is the difference? Oh, yes.
Insurance is when you expect something bad to happen. Speculation is when you expect something good to happen.
Interesting, but I'm not sure. I like that explanation. It's very creative. So you're saying that insurance, people who have insurance are just gloom and doom people, and people who are speculators are interesting. That's a behavioral notion, and maybe some of that is at play. But ultimately, from an economic standpoint, there's an economic explanation. With insurance, you really are dealing with two states of the world. One is the no-loss state and the loss state. In insurance, there is no state of gain. You don't buy an insurance contract to make money. You cannot do it. In fact, if you try to do that, you're not going to be successful. Insurance contracts deal with the no-loss state and the loss state. There is no third state. Speculation, when you speculate, you're trying to make money. That's why you speculate. Nobody speculates to lose money, right? You don't, hey, I'm going to put in $5,000 in the market. I want to just lose it all, right? Nobody does that. You're putting in whatever money it is, $500, $200, $100, $1,000, to make money, to make that money grow, which is why you're speculating. Now, granted, all the time that doesn't happen, sadly. You do lose money in markets, but the fact is that is why we invest. That is why we speculate. To make money, to make our initial sum grow. So there is a gain state of gain. So with speculation or investments, there are broadly three states of the world. Gain, a state of gain, no change, and loss. In insurance, it is two states, no change and loss only. There is no upside to insurance. That's why it's a defensive strategy, folks. That is why we play defense. That's why we say it's playing defense. If it had the gain state, then it would be playing offense as well, which we are not. Right? Okay, so that takes care of that deep thought. So odds makers. So just like in Las Vegas, you have this right before this whole March Madness that's going on right now, and all this billion-dollar hype, which was nothing but a hype because statistically we knew that chances of that, somebody having a clean bracket, perfect bracket, was pretty much 1 in 100 billion or something like that. So that was not going to happen, and that didn't happen. It was all decided. But some people got great publicity out of it. But so Las Vegas has odds makers. For any event, any football game, basketball game, there are odds that come out of the statisticians and stuff who are at payroll of these large bookie companies, or these companies where you can place bets. And they provide these odds for any of these events. And So the insurance company is in some sense the odds maker in the insurance world. They are the ones that decide what kind of odds to give you. So they look at you as a risk and then try to figure out, so if it's a health contract that you want, a health insurance contract, they're going to look at your health records, they're going to see how healthy you are, what kind of lifestyle you lead, do you go running, do you work out, do you know, what's your body fat content, what's your weight, what's your, you know, what's your health history, basically. What kind of inherited, because as you may or may not know, my doctor is fond of telling me that in every visit, that there's only 50%. You can kill yourself with diet and exercise. You can only affect 50% of your health. The other 50% you inherit, and you have no control over that. That's from your parents. Okay, so whatever you inherited, that's 50%, and the rest of what you do through diet, exercise, and all of the other good stuff is basically counting for only 50% of the change. So they're going to look at your genetic history, you know, to see how many heart attacks and how many other things that you have in your family, and that's going to impact the risk factor, your risk factor. And so those are the kind of information that insurance companies will need from you in order to make an educated guess on the odds, to give you odds. What are your odds of falling sick? Because insurance companies, at the end of the day, want to sell you a policy for an appropriate rate that you will buy it for, and then will proceed to never use it. Use the contract. And that's the ideal contract, right? Where you, as a customer, you don't feel like you're being cheated, you're not being charged too much, whatever that means. And the insurance company hopes that you never use that contract, because then they get to keep all the premium that you're going to be paying every quarter, every 6 months, every year, so on and so forth. So that's what the insurance company does, and insurance companies spend billions of dollars in their algorithms in trying to get those kind of accurately pin down your odds corresponding to every customer they have, the millions of people they have. Okay. Is it me today? Why are people just leaving? It's starting to bother me. And I did shower too. Yeah, I don't know. Anyway, so that's odds maker. And then underwriting. Underwriting is a process by which insurance companies decide who to insure, because insurance companies have the right to refuse. They can, if they consider you a high enough risk candidate, you're not going to get a policy. Them to sell. I mean, they're going to sell you a policy, but it's going to be so expensive that you'll refuse it anyway. So that's their. That process is called underwriting. Although not to be confused with investments, have underwriters as well, as we talked about with the IPO issue and all that, and they underwrite the risk of a starting business. So in a way, those stock underwriters are managing risk of new companies in the investment space, and the traditional insurance companies are managing risk in the personal space of individuals, right, of their health, risk associated with home ownership and car ownership and health ownership and all that stuff. So that's what the health side traditional insurance companies are doing, and then you have the investment insurance companies or underwriters or brokers, or the Prudentials and the CFA or Credit Suisse, First Bostons of the world, who are then underlying risk of insuring risk of companies. So they're both underwriters, but in different space. So insurance company economics, so it's really a risk pooling argument, very simply stated. How does it work? You get a ton of people to put money into this hypothetical basket, and then as long as relatively less people draw out of it, the difference, the insurance companies run well. So if you have a billion people paying their semi-annual premium money, and then only a portion of that gets taken out by people filing claims, then the rest of it stays with the insurance companies, and insurance companies can invest it and so on and so forth, which they do. Insurance companies are known to have large amounts of cash that they sit on, and they invest that. They invest that money into buying bonds, mostly high-quality bonds. So, and there's a reason for that. Bonds are considered to be safer investments, and insurance companies are the keeper of the public trust. Therefore, insurance companies are heavily regulated in this country by US Congress and others, and therefore they have serious restrictions placed on what they can do with consumer money. And one way that they can invest is to buy high-quality bonds, AAA rated bonds. Okay, so those are the highest quality bonds, lowest risk bonds that they can invest in for the most part.